Hi guys, welcome to my channel. So before we get started, hit that like button and subscribe to my channel. In this video, we will talk about 50-30-20 budgeting, so make sure to watch the full video. Budgeting doesn't need to be complicated, nor should it take hours out of your day. In fact, the best ways to budget are often the simplest. Take, for example, the 50-30-20 rule. The 50-30-20 rule is a straightforward monthly budgeting method that tells you exactly how much to put towards your savings and your living costs each month. With a clear big picture overview of your budget for the month, you can confidently avoid overspending and build up your savings over time, all without painstakingly recording every single transaction. So, if you've ever downloaded a budgeting app only to abandon it by the third day, you might want to give the 50-30-20 method a try. It's one of the best budgeting tips we found, and here's how it works. What is the 50-30-20 rule? The 50-30-20 rule is an easy budgeting method that can help you to manage your money effectively, simply and sustainably. The basic rule of thumb is to divide your monthly after-tax income into 3 spending categories: 50% for needs, 30% for wants, and 20% for savings or paying off debt. By regularly keeping your expenses balanced across these main spending areas, you can put your money to work more efficiently. And with only 3 major categories to track, you can save yourself the time and stress of digging into the details every time you spend. One question we hear a lot when it comes to budgeting is, why can't I save more? The 50-30-20 rule is a great way to solve that age-old riddle and build more structure into your spending habits. It can make it easier to reach your financial goals, whether you're saving up for a rainy day or working to pay off debt. Where did the 50-30-20 rule come from? The 50-30-20 rule originates from the 2005 book, All Your Worth: The Ultimate Lifetime Money Plan, written by current U.S. Senator Elizabeth Warren and her daughter Amelia Warren Tyagi. Referencing over 20 years of research, Warren and Tyagi conclude that you don't need a complicated budget to get your finances in check. All you need to do is balance your money across your needs, wants, and savings goals by using the 50-30-20 rule. How to budget your money with the 50-30-20 rule? The 50-30-20 rule simplifies budgeting by dividing your after-tax income into just 3 spending categories: needs, wants, and savings or debts. Knowing exactly how much to spend on each category will make it easier to stick to your budget and help keep your spending in check. Here's what a budget that adheres to the 50-30-20 rule looks like. Spend 50% of your money on needs. Simply put, needs are expenses that you can't avoid, payments for all the essentials that would be difficult to live without. 50% of your after-tax income should cover your most necessary costs. This budget may differ from one person to another. If you find that your needs add up to much more than 50% of your take-home income, you may be able to make some changes to bring those expenses down a bit. This could be as simple as swapping to a different energy provider or finding some new ways to save money while grocery shopping. It could also mean deeper life changes, such as looking for a less expensive living situation. Spend 30% of your money on wants. With 50% of your after-tax income taking care of your most basic needs, 30% of your after-tax income can be used to cover your wants. Wants are defined as non-essential expenses, things that you choose to spend your money on, although you could live without them if you had to. Following the 50-30-20 rule doesn't mean not being able to enjoy your life. It simply means being more conscious about your money by finding areas in your budget where you're needlessly overspending. If you're confused about whether something is a need or a want, simply ask yourself, could I live without this? If the answer is yes, that's probably a want. Stash 20% of your money for savings. With 50% of your monthly income, going towards your needs and 30% allocated to your wants, the remaining 20% can be put towards achieving your savings goals or paying back any outstanding debts. Although minimum repayments are considered needs, any extra repayments reduce your existing debt and future interest, so they are classified as savings. Consistently putting aside 20% of your pay each month can help you build a better, more durable savings plan. This is true whether your ultimate goal is building an emergency fund, developing a long-term personal financial plan, or even preparing for a down payment on a house. How to apply the 50-30-20 rule, a step-by-step guide. So, how do you actually use the 50-30-20 rule? To put this simple budgeting rule into action, you'll have to calculate the 50-30-20 ratio based on your income and categorize your spending. Here's how. 1. Calculate your after-tax income. The first step to using the 50-30-20 budgeting rule is to calculate your after-tax income. If you're a freelancer, your after-tax income will be what you earn in a month, minus your business expenses and the amount you've set aside for taxes. If you're an employee with a steady paycheck, this will be easier. Take a look at your payslip to see how much lands in your bank account each month. If your paycheck automatically deducts payments such as health insurance or pension funds, add them back in. 2. Categorize your spending for the past month. To get a true picture of where your money goes each month, you'll need to see how and where you've spent your income over the past month. Grab a copy of your bank statement for the past 30 days or simply use the Insights feature in your N26 app. It automatically sorts all your transactions into categories such as salary, food and groceries, leisure and entertainment, and more. Now split all your expenses into the 3 categories: needs, wants and savings. Remember, a need is an essential expense that you can't live without, such as rent. A want is an additional luxury that you could live without, such as dining out. And savings are additional debt repayments, retirement contributions to your pension fund, or money that you're saving for a rainy day. 3. Evaluate and adjust your spending to match the 50-30-20 rule. Now that you can see how much of your money goes towards your needs, wants and savings each month, you can start to adjust your budget to match the 50-30-20 rule. The best way to do this is to assess how much you spend on your wants every month. According to the 50-30-20 rule, a want is not extravagant. It's a basic nicety that allows you to enjoy life. As cutting back on your needs can be a complex and challenging task, it's best to work out which of your wants you can cut back on to stay within 30% of your take-home income. The more you reduce spending on your wants, the more likely it is that you'll be able to hit your 20% savings target. 50-30-20 rule spreadsheet. While our 50-30-20 rule calculator can provide a general overview of your ideal 50-30-20 rule budget, a 50-30-20 rule spreadsheet is a good option if you'd like to create a more in-depth budget. Spreadsheet software such as Microsoft Excel, Google Sheets, and Apple Numbers all offer pre-made templates to help make spreadsheet budgeting easy. You can find plenty of free online 50-30-20 rule spreadsheets that are compatible with whichever program you're using. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.